NEOM. That is the name that Saudi Arabia has given to the project on which they recently broke ground, also known as the Line, which they say will redefine the concept of urban development. So what exactly is the Line? Well, it's 170 kilometers long, but only 200 meters wide, with a mirrored surface on the outside and a high-speed rail that can go from one end to the other in 20 minutes. It's a human habitat intended to house 9 million residents with easy access to all necessary services within a 5-minute walk, completely self-sustaining and carbon neutral. So whether that sounds like paradise or prison to you, it is definitely a sign of major changes in how human beings work and live together. World changes are happening fast, and they impact both investment opportunities and risks. So each year, Arnerich Massena's research team gets together to really look at the big picture. So whereas our investment committee meets frequently to discuss market changes and tactical investment moves, this meeting is a single end-of-year gathering to really peer into the future and brainstorm the large cultural trends that will affect the investment landscape as we go forward. So we take off our analytical hats and put on futurist hats for a bit. It's less about the markets, but more about the context that will set the stage for creating investment opportunities and risks. So of course we can't know the future, but it's fun to think about and entertaining to hear about some of the ideas that come out of it. These are not meant to be investment advice or recommendations, but an interesting look at big picture events and shifts. Human beings live by stories. Stories shape our narrative, help us understand the world and how to think about it, and ultimately drive behavior. And of course, investing is all about understanding behavior. Today's Senior Research Analyst Arthur Coyne and I will share some of the stories that we envision may play a role in the coming year. My name is Jillian Perkins, Director of Communications, and it's my pleasure to welcome you today to Investment Trends to Watch For in 2023, The Money Revolution. Thank you for joining us today.
This is the story of the Line. Here you can see a digital image of what the Line is intended to look like when it's completed. Many people who grew up as a baby boomer, Generation X, or a millennial may have grown up dreaming of buying a home in the suburbs, commuting to their workplace, and retiring in their golden years to travel and enjoy their grandkids. But Generation Z and later may be looking forward to a very different future that is now being turned into a reality by Saudi Arabia's Line. And Saudi Arabia is not the only country looking for more sustainable ways to manage its human population. Western nations are exploring the idea of smart cities, which use technology and surveillance to manage urban centers with a smaller footprint. One of the first things likely to go are personal vehicles as we switch to remote work, create spaces based on foot traffic, employ driverless taxis, and use drone delivery services. Single-family home ownership may also become a thing of the past. Currently, institutional players are buying homes to turn them into rentals, and many young families may not be able to afford home ownership at rising prices. Is this the end of the American dream or the beginning of a post-industrial utopia? That remains to be seen.
With record inflation and debt levels, money has certainly been in the headlines this year. And now, with the recent collapse of crypto exchange FTC, we're seeing larger questions about money regulation and currency taking center stage. So while speculators have been testing the waters with Bitcoin, Ethereum, and the hundreds of cryptocurrency options, governments and central banks have been exploring the possibility of issuing their own digital currencies. So you might say, well, isn't that just an electronic version of an existing currency? As in, wouldn't a digital dollar be the same as a regular dollar, since most of what we do is already digital anyway? And the answer is not really. A true digital currency is not necessarily just an electronic version of an existing currency. Central bank digital currencies, called CBDCs, come with some unique features. So one of the biggest differences is that CBDCs can be programmed. Right now, when the Federal Reserve wants to stimulate the economy, they can lower interest rates, but they can't go below zero. But if we were all using a CBDC, they could program negative interest rates into the CBDC, shrinking the value of any unspent currency after a certain period of time in an effort to stimulate spending. Things like taxes, fees, penalties, even something like traffic tickets could be withdrawn automatically from someone's CBDC account. That's only the beginning of how they can be programmed. So many people are talking about how programmed CBDCs can help nudge behavior. The book Nudge was brought to us by behavioral economists Richard Thaler and Cass Sunstein, in which they outline the ways in which incentive structures and presentation can help guide or nudge individuals in their decision-making. MasterCard recently launched its Doconomy card based on that same principle. The card assigns points to your purchases according to their carbon footprint, and then assigns carbon limits to your spending, which is intended to nudge consumers to make more sustainable consumption choices. Imagine programmable CBDCs that placed limits on things like gasoline or parking to reduce your use of a personal vehicle, or even things like candy or junk food or video games. So as we explore digital money, the idea has become much more politicized with these kinds of decisions on the table, and we expect that the money revolution is just beginning.
One of the trends we followed for quite some time has been the process of globalization, and it's featured heavily in our past investment trends predictions. But this year, that process is reversing itself, and we're looking at the beginning of deglobalization. With travel restrictions, political tensions, trade wars, and climate issues all contributing to supply chain failures, organizations are increasingly realizing the value of self-sufficiency. Looking for resources closer to home, often called economic nationalism, can make the world more resilient, but it can also lead to higher prices and inflation as low-cost imports are replaced with more expensive, locally sourced goods and services.
Home ownership isn't the only kind of ownership we see fading into the past. SaaS refers to software as a service, and over the past few years, software companies have rapidly adopted a model in which users pay a subscription fee rather than just buying the software outright. They usually get access to upgrades and customer service, while the software company gets predictable and stable future income. So this model is moving well beyond software now. Some people already use a subscription model for their phones, for example, where you don't own your phone, but periodically turn it in and upgrade to the newest model. Of course, most of us are very used to subscribing to streaming services for entertainment, and even movie theater chains are starting to offer memberships in lieu of individual tickets. More and more people are leasing cars, and this past year, we saw BMW begin asking car owners to pay an additional monthly fee to access some features of their cars, such as heated seats. Food delivery, education programs, news sites, the subscription and membership model is expanding, and it offers convenience and improved service for consumers and ongoing revenue for businesses. So as this shift happens, we may see less and less ownership of physical goods as our approach begins to become one of usership rather than ownership. The downside is that less ownership means less stewardship. Rather than caring for and fixing things, people will simply trade up to the newest model.
You may know someone who placed a bet on the outcome of the recent midterm elections, or maybe you watched the odds as they fluctuated in different races. Prediction markets that allow people to trade contracts based on the outcomes of future events have been around for a while, but they're now gaining legitimacy in addition to popularity. The Commodity Futures Trading Commission, or CFTC, is the regulatory agency in charge of these markets. In the past, they reacted ambiguously, but they seem to be warming up to prediction markets, with ex-commissioner Brian Quintes joining the board of Kalshi, one of the most well-known of these markets. So our prediction is that we will continue to see the growth of prediction markets and opportunities to trade on and hedge against a variety of events.
So we talked about remote work replacing a commuter model, but the other change that will reshape the working world is automation and artificial intelligence. If you caught AI Day 2022, you saw the unveiling of Tesla's humanoid Optimus robot. As a prototype, it's got a long way to go before it's especially useful, but there are plenty of robots and automation already creeping into our daily lives. They may not always look human, but you encounter robots and AI frequently, as in call centers, retail, scheduling, reporting, and communications. Transportation and manual labor are likely the next to see a wave of automation. So, of course, this trend will be bad news for jobs initially, as jobs are replaced with robots and automated processes. And for many businesses, it will be essential to automate processes in order for them to be able to remain competitive. However, long-term, it may eventually lead to a whole new job landscape with professions that demand greater imagination and ingenuity, as we're relieved of dull, repetitive tasks and can focus on more interesting and creative activities, or on work that requires more human contact and personal care. And of course, there will be lots of work related to the development and upkeep of robots and AI. Imagine a whole field of robot psychologists to help robots develop more human personalities and interfaces.
Inflation was the big story of 22, and we don't expect it to go away completely in the coming year, although it may slow somewhat. This is a mixed bag for investors and consumers. For investors, inflation's led to higher return expectations on cash, CDs, and fixed income investments. But if inflation persists, the less those future dollars will be able to purchase. This creates a push and pull between saving and spending as people try to find the right balance between taking advantage of higher interest rates on saving, but also making their dollars count at the lower prices available now, especially for real assets such as real estate, commodities, and even gold and silver. So in this next year, we'll all be watching to see if the Fed raises interest rates high enough to encourage savings and bring inflation under control.
How do you prove that you are you? In today's world with identity theft, data breaches, and even deepfakes, it's getting ever more difficult to secure your identity and even to prove your humanness in an online world full of bots. If you've ever had to check that little box that says, "I'm not a robot." So more and more, we're seeing the use of biometric data being used in an attempt to solve for these issues. Things like your fingerprints or palm scans, retina and iris scans, facial recognition, and even gait measurement and voice recognition. So theoretically, biometric information can't be stolen or forged, and you can't lose it or forget it, making it well suited for identity authentication. On the other hand, there are risks. One is that the technology is not perfect, and we have already seen things like facial recognition failures. And when that happens in areas like law enforcement, there's a very high potential cost to failure. There are also privacy concerns. Once your biometric data is in the hands of a third party, you no longer have control over how it is stored or used. So in 2023, we may see battles over things like digital identity, privacy, data control, and data collection.
This past year, many investors felt there was nowhere to turn. Stocks and bonds were both struggling, and with inflation, even cash holders were suffering. But one sector strengthened despite the challenging market environment, and that was energy. When we talk about investing in what the world needs, along with food, water, and healthcare, energy is at the center of that. The world needs energy to thrive, and while we'd all like to use renewable sources as much as possible, it may take some time to build the necessary infrastructure that will allow us to move away from legacy sources such as fossil fuels. So while we transition, we'll need investment across the energy sector in all types of sources and solutions.
Mutual funds were designed to provide investors with a way to diversify their investments cost effectively. Rather than trading multiple stocks individually and paying the accompanying trading costs and commissions, one could purchase a single investment diversified across multiple holdings. And one of the primary values of that structure is the reasonable cost. This last October, we hosted a webinar about customized indexing. And in the webinar, we pointed out that there has been an enormous reduction in trading costs over the past few decades. And now technology has rendered the cost more or less negligible and trading frictionless. So this opens the door to custom indexing, in which investors start with an index fund, but then apply personalized screens to select or deselect holdings in the fund. By structuring the product as a separate account, investors can choose the sectors and companies they want to include or not include in their portfolio. In addition to making it possible for investors to align their investments with their values, this also makes possible a daily tax loss harvesting strategy, which can add meaningful tax efficiency to a portfolio. We anticipate this structure will quickly gain in popularity and use. So where does all that leave us? As we head into 2023, we're probably looking at a recessionary environment, and we will see winners and losers. Companies that have clean balance sheets and pricing power have a significant advantage, whereas organizations that are carrying debt will struggle with rising interest rates. With inflation, belts will be tightening, and companies may see their customer base shrinking as a result. This all will likely cause some job losses, and that's at the same time that automation is replacing jobs as well. And lastly, this coming year will be one of working to rebuild supply lines and adapt to a shifting global environment. Within all that, there are always opportunities, and our job is to find where capital will have the most potential for growth and impact. We'll be looking at how to counter the effects of inflation, how to take advantage of new investment structures like custom indexing, and on innovations in energy, financial services, and other industries. So we'd like to thank you for taking a peek into the future with us today. Please feel free to read our full investment trends to watch for piece available on our website at arnerichmassena.com. We look forward to seeing you in 2023, and thank you so much for joining us today.